Welcome back, fellow digital asset enthusiasts, to another deep dive into the ever unpredictable, yet endlessly fascinating world of cryptocurrency. It's been a week, hasn't it? A week where Bitcoin decided to remind everyone who's boss, Ethereum flexed its institutional muscles, and Washington, in a rare moment of clarity, actually started talking about crypto in a way that didn't involve banning it outright. Yes, you heard that right. The gears of bureaucracy are grinding, and surprisingly, it might just be in our favor. For those of you who've been glued to the charts, you know exactly what I'm talking about. Bitcoin, the OG, the digital gold, the one asset that seems to thrive on chaos, has once again defied expectations. It didn't just break its all-time high, it smashed it, leaving a trail of liquidated shorts and bewildered bears in its wake. We're talking about a move that had even the most seasoned analysts raising an eyebrow, wondering if perhaps, just perhaps, this time it's different. Spoiler alert, it always is, and it never is. That's the beauty of crypto, isn't it? But it wasn't just Bitcoin hogging the spotlight. Ethereum, our beloved smart contract king, decided it was tired of playing second fiddle and surged past the $3,000 mark. This wasn't just a sympathetic rally, this was a move fueled by some serious institutional interest and a narrative that's finally gaining traction. Tokenization. Imagine a world where everything from real estate to your grandma's antique spoon is on the blockchain. We're not quite there yet, but the foundations are being laid brick by digital brick. Now, let's talk about the elephant in the room, or rather, the suits in the room, Washington. For years, we've watched with bated breath as politicians debated, deliberated, and mostly just dithered on crypto regulation. But this week, something shifted. We're in the midst of what's being dubbed Crypto Week on Capitol Hill. Yes, the same Capitol Hill that once struggled to understand what a Bitcoin even was, is now debating actual legislation that could provide much-needed clarity for our industry. It's almost as if they realized that ignoring a multi-trillion-dollar asset class might not be the smartest long-term strategy. Who knew, right? This newfound regulatory enthusiasm, or perhaps reluctant acceptance, is a massive tailwind. It's attracting a new wave of institutional money, the kind that moves markets, not just memes. We're seeing it in the ETF inflows, the on-chain data, and the general buzz around the space. It's a sign that crypto is no longer just a fringe asset for tech geeks and rebels. It's becoming a legitimate, albeit still wild, part of the global financial landscape. However, before we all start popping champagne corks and planning our moon landings, let's inject a dose of reality, shall we? The macro environment, as always, remains a mixed bag. The Federal Reserve, in its infinite wisdom, has hinted at a more dovish stance, which for those of us in crypto usually means printer go burr, and that's generally good for our bags. But let's not forget the specter of inflation, that pesky little economic boogeyman that keeps rearing its head. And then there are the tariffs. Just when you thought things were getting predictable, a new trade war threat emerges, reminding us that the global economy is a delicate dance, and crypto, for all its decentralization, is still very much a part of it. The market, in its typical fashion, is seeming to shrug off these concerns for now, but they are the silent assassins lurking in the shadows, waiting for their moment to strike. But here's where it gets interesting. The on-chain metrics, the real pulse of the market, are screaming bullish. We're seeing a significant decrease in Bitcoin supply on exchanges, which means fewer people are looking to sell. Whale accumulation is on the rise, indicating that the big players, the smart money, are buying up supply. And open interest in futures markets is soaring, suggesting that traders are confident in the current rally. It's like watching a perfectly choreographed ballet, but with millions of dollars at stake and the occasional dramatic tumble. This data suggests that this isn't just a speculative frenzy, there's genuine conviction behind this move. So, what does all this mean for you? The astute investor, the brave trader, the one who dares to navigate these choppy waters? In the short term, expect volatility. The outcome of Crypto Week in Washington will be a major catalyst. If these bills pass and provide a clear regulatory framework, we could see another leg up. But if there are any delays, any political squabbles, any unexpected bureaucratic hiccups, prepare for a sharp pullback. This market, much like a teenager, can be incredibly moody. In the long term, however, the outlook remains overwhelmingly positive. The increasing institutional adoption, the relentless pace of technological innovation, and the slow but steady march towards regulatory clarity are all powerful tailwinds. Bitcoin and Ethereum, in my humble opinion, are poised to continue leading the charge, but keep an eye on the old coins, especially those with real-world utility. The next bull cycle, whenever it truly ignites, will likely see some unexpected winners emerge from the shadows. My advice: be cautiously optimistic. This is not the time to go all in on speculative plays, but it's also not the time to sit on the sidelines. Consider taking some profits, securing your gains, but maintain a long-term position in the foundational assets. And most importantly, do your own research. The market is a wild beast, but with the right knowledge and a bit of foresight, you can tame it, or at least ride the wave without getting completely wiped out. That's all for this week's market update. Stay safe out there, stay informed, and remember, in the world of crypto, fortune favors the bold, but it truly rewards the patient. See you next time.